Hi, our topic for today is the measurement of inventory. So for this video, we will learn how to measure the inventory. So in measuring the inventory, we need to learn the following items. First, of course, is the initial measurement of the inventory. Second is the subsequent measurement of the inventory. Third, we split the cost of inventory as to an item of your ending inventory and your item of cost of goods sold. Okay, so these are the following items that we will learn in this particular video. So start now with your initial measurement. So how do we initially measure your inventory? So the initial measurement of inventory is equal to your cost of purchase, cost of conversion, and other costs. Okay, so your initial measurement is composed of cost of purchase, cost of conversion, and other costs. So you add them all, this will give you your initial measurement. So first we go with your cost of purchase. So what is your cost of purchase? Your cost of purchase is your purchase price, import duties, and non-recoverable taxes. And of course, your transport and handling costs. Transport and handling costs. Okay. So these are the following items of your cost of purchase: purchase price, import duties, and non-recoverable taxes, transport and handling costs. So we start first with your purchase price. The purchase price is of course the cash price or the price of the inventory. So whatever is the price of the inventory, that is the purchase price. So you already know how to initially measure your receivables in case uh, you purchase a an inventory through a payable or note payable. You follow the rules in notes receivable. It's almost the same with notes payable, wherein you just need to get the present value of the principal and you need to get the present value of the interest. If you issued a loan for the purchase of the inventory, you still need to follow the rules on your loans receivable. Except, of course, there is a different measurement as to the initial measurement of your loan payable. If you issue accounts payable, then you already know the recognition in your accounts receivable is the same with your accounts payable. Okay, so that's for purchase price. Next, import duties and non-recoverable taxes. What are these import duties? These are the duties or custom duties due to the importation of the inventory. So this is only present if ever the inventory is imported. Inventory is imported, so you pay import duties or custom duties. Next, you have your non-recoverable purchase taxes. What is this non-recoverable taxes? When we say non-recoverable taxes, this pertains to non-VAT, because if ever the purchase includes VAT, if the purchase includes VAT, you remove the VAT. Why? Because VAT is considered as a recoverable tax. It is considered as a recoverable tax, especially for a VAT taxpayer. How about if a non-VAT taxpayer that is not a recoverable tax? Why? Because you cannot offset it to any VAT liability, or the input VAT on purchase cannot be removed on an output VAT. There will be no output VAT for a non-VAT. But again, take note, a recoverable tax includes VAT. So in case the inventory includes VAT, you remove the VAT. Next, transport and handling costs. So this pertains to your freight costs. These are your directly attributable costs. Next, you have your cost of conversion. So for your cost of conversion, you already know this one and very familiar with this. This is their direct labor and your overhead. And your overhead is either fixed overhead or variable overhead. Fixed overhead or variable overhead. So take note, fixed overhead is allocated using normal capacity. So if ever you use only normal capacity, so you allocate it using normal capacity. And variable overhead must be allocated using the actual use. Allocated using the actual use, okay? So it's allocated using the actual use. So OH, FOH, VOH, FOH using normal capacity, VOH actual use, direct labor, of course, is your wages. Next, you have your other costs. Other costs. So what are these other costs? First is your borrowing costs, which can be capitalized. So capitalizable borrowing costs. So only those capitalizable borrowing costs should be included. Next, you have your overhead costs for a specific customers. So overhead costs for a specific customers. So what are these overhead costs for specific customers? So if ever it is made to order and you incur overhead specifically for that customer, that overhead is included in your other costs. Okay, so take note of this initial measurement. We have your cost of purchase, cost of conversion, and other costs. And your cost of purchase is composed of your purchase price, import duties, and non-recoverable taxes, plus transport and handling costs. Your cost of conversion is your direct labor and your overhead. Take note that FOH must be allocated using normal capacity, while VOH is allocated using actual use. While other costs are the following: you have your borrowing costs, which is only used if ever it is capitalizable. And take note, the asset must be a qualifying asset. So in case you are making an inventory and it takes time for you to complete that particular inventory, that can be a qualifying asset. But not all inventory can have a borrowing cost, okay? So it must be a qualifying asset. When we say qualifying asset, it takes substantial time to finish or create or manufacture that inventory. Second, overhead costs for specific customers. This happens, guys, if in case there is a specific order or made to order. So you just add that in your other costs. So what are the items excluded from the cost of inventory? So if ever you already know the items of cost of inventories, purchase, conversion, and other costs, the standard also includes cost of inventories, which are specifically excluded. So the standard also provided costs which are to be excluded. So first, of course, is your foreign exchange differences. Foreign exchange differences. So in case there are differences as to the purchase of the inventory through the foreign exchange. So for example, you purchased today and you paid only after a year, there is an exchange difference that is not included as the cost of inventory. Next, we also have your interest costs. Interest costs for deferred settlement. Interest costs for deferred settlement. So in case there is an interest cost on the portion of your deferred settlement, we remove it. So, sir, when can we say that there is an interest cost for deferred settlement? So for example, you provide a non-interest bearing note. If the note is 3 million, of course, a portion only pertains to the principal, which is the present value, and a portion pertains to the interest. This is the unearned interest income. So you remove this unearned interest income. So this is the interest cost on deferred settlement. You only include the value of the present value, which is the non-interest bearing, which applies now to non-interest bearing notes. So interest cost for deferred settlement. Next, we have your abnormal amounts. So in case there are abnormal amounts of labor, materials, and other protection costs, these are excluded as cost of inventories. So take note, we only use normal capacity. That's why if it's abnormal, do not include. Next, we also have your administrative overheads, admin overheads unrelated to production. Take note, for overheads, it must be particularly for production, or it must relate to production. If it is unrelated to production, you exclude it. Next, you have your storage costs. So the cost of storing the materials or the cost of storing the inventory should not be included. It is excluded. Next, we also have your selling costs. So since we exclude these items, what is the treatment? So the treatment of these items, it will be part of expenses. Particularly OPEX. Okay? So we have here the items of inventory which must be excluded. So first, foreign exchange difference. So difference over the purchase price of the inventory that is due to foreign exchange, it must be excluded. Next, interest cost on deferred settlement. This is the unearned interest income that you know in your notes, and in your loans, you remove that. Next, we have your abnormal amounts. Abnormal because we only include normal amounts as cost of inventory. Any cost above the normal, it is excluded. Next, administrative overhead unrelated to production. So take note, any overhead that is not particular or related to the production must be expensed. Next, you have your storage costs. So for your storage costs, this is the cost of storing the inventory. It is not necessary for the present location and condition of the asset. In short, it is not used for the purchase. It is not used for the production. Then it is excluded. Next, you have your selling costs. So this is your S&A or selling and admin costs. It is part of your operating expenses. Further, take note of this. Pass to, under one of its paragraph, provided that any discounts, particularly trade or rebates, should be deducted in advance. And I know that you already know the effect of a trade discount, because a trade discount is not recorded. So a trade discount should be removed at the purchase price. Okay, so take note of this. How do we initially measure your inventory? We initially measure it as cost of purchase, cost of conversion, and other costs, and there are items inside those costs, and you net it of any trade discounts. What items or costs are to be excluded into the cost of your inventory? So we have your FIAS or FIAS. So FIAS. So FIA squared S squared. Foreign exchange differences, interest costs, abnormal amounts, admin, storage, and selling costs. Okay? FIAS. So that is for pass 2 on your initial measurement. So guys, on your initial measurement, always take note of this cost to include and cost not to be included. So certain items or purchase issues that we need to learn into your initial measurement. So purchase issues as your initial measurement. First, if ever it is a deferred payment, take note guys, if it's deferred payment, it should be net of interest costs. So for example, purchase inventory for a consideration of a note payable, 3 million. The market interest rate on the note is 10%. The note is due after 2 years. Okay. So the note is due after 2 years. So what happens here, guys, is that we need to get for the value of our note, and we need to net it at the interest cost. We net it out of the interest cost. So we just get the PV of the note. So still 3 million, 10%, 2 years. So 1.1, 2 periods. And we multiply it to 3 million. Then we have 2,479,338.84. So this is the value of the inventory. So we already net it of interest cost. Okay, so if ever it is deferred payment, whatever deferred payment, and there is an interest cost out of that, you remove it. But sir, what if it is interest bearing? If it's interest bearing, no problem. Kasi nga, di ba, we assume that the interest is the same with your market interest rate, except if it's not the same. If it's not the same, and it is substantially different, okay? So deferred payment. Another purchase issue is a lump sum cost. Lump sum cost. So what is this lump sum cost? This is inventory purchase at a lump sum price. Inventory purchase at a lump sum price. So how should we measure the inventory? So the purchase price of inventory should be allocated to the different inventories, at their relative fair value. Relative fair value. So for example, so purchase inventories for 3 million pesos. The inventories are inventory A, inventory B, and inventory C. The relative fair value of inventory A is 500,000, B is 2 million, C is 2.5 million. Okay, so how should we allocate it? We allocate the the purchase price to the inventories at relative fair value. So we need to get for a fraction. Sir, what is that fraction? That is the relative fair value of the inventory divided by the total relative fair value. Total relative fair value. So here we have A, we have B, and we have C. The amount to be allocated is 3 million. We just need to get for the fraction. So for letter A, the relative fair value of A is 500,000. The total of our relative fair value is 500 plus 2 million plus 2.5, 5 million. So 500 over 5 million. Letter B, 2 million over 5 million. Letter C, 2.5 million over 5 million. Okay, so we just allocate it. So 3 million times 500 divided by 5 million is 300,000. And this is 1.5 million. This is 1.2 million. Okay, so you just allocate it as to the relative fair values. That's one example. Another example, purchase inventories for 3 million. The inventories are letter A, letter B, letter C. So you are given the units and the selling price or the relative fair value of each. So if ever, let's say letter A is composed of 1,000 units, letter B is 2,000 units, letter C is 3,000 units, and letter A 50,000 pesos per unit. This is the selling price, 50,000 per unit. This one is 100,000 per unit, and this one is 5,000 per unit. So what we do here is we get the total relative fair value. So what's the difference as to the first example to the second example? On the first example, automatically the total relative fair value per unit was per inventory was given. Here, we need to get first for the relative fair value of each particular inventory. So for letter A, so we have 1,000 times 50,000, we have 50 million pesos. Next, we have 2,000 times 100,000, we have 200 million pesos. And next, we have 3,000 times 5,000, we have 15 million pesos. Okay, so this will give us 265 million. So A, B, C, 3 million. multiplied by the relative fair value, fraction still A, 50 over 265. B, we have 200 over 265. C, 15 over 265. Okay, so let's compute. 3 million times 50 over 265. So this is 566,037.74. Next, we have 200 over 265 times 3 million. We have 2,264,150.94. Letter C, we have 3 million times 15 over 265. So we have 169,811.32. Okay, so guys, here, take note, we computed first for the relative fair value of each, and then out of the total relative fair value, we get the fraction. Okay, and sometimes, guys, you are asked, what is the per unit? So if ever you are asked for the per unit, you just divide the allocated cost. So pag per unit ang tinanong, allocated cost divided by the units per inventory. So for example, for A, we have 566,037.74. You divide it over 1,000 units, okay? So here, as you can see, you just need to divide it in the units. So the per unit cost is 566.04. Ganun siya. If ever the question is unit cost. But what is the allocated cost? The allocated cost is this one. The allocated cost is this one, okay? So again, purchase issues. First, purchase a deferred payment. Take note, when we purchase at a deferred payment, we just need to remove the interest cost inside it. Next, if ever purchase at a lump sum price, take note what we do here is to at least allocate the cost of our inventory to the relative fair value. Okay, sir, question. What if there is no relative fair value or not all relative fair values are given? So if not all relative fair values are given, you allocate first to the inventories with relative fair value. Excess to the inventory without relative fair value. Okay? So if there's no relative fair value, in short, not all inventory has relative fair value. So not all inventories are given as to the relative fair value. So what do? We allocate first the inventory with relative fair value and any excess to the inventory without relative fair value. For example, okay, so our lump sum price is still 3 million. So sometimes lump sum price is known as basket price, okay? So if ever lump sum price or basket price yung sinabi ng problem, pareho lang yun. Okay, so if the lump sum price is 3 million and you purchase the following inventories, A, B, C, the relative fair value of A is 500,000, B is unknown, C is 1.8 million pesos. Okay, so if this is the case, what we do, we allocate first to the inventory with relative fair value. So what is the allocation for A? 500,000 because it is known. C is also known, 1.8 million. This is unknown, so we get the excess. So if ever we purchase it at 3 million, you remove the 500, you remove the 1.8 million, the excess is equal to 700,000. Okay, so that's it. If ever not all relative fair values are known. Okay, sir, what if all of the relative fair values are unknown? If all of the relative fair values are unknown, that would be hard. That would be hard. You record it based on the cost. You record it based on the cost na. So you can measure, you cannot measure the relative fair value. You measure the cost of each. So let's say the cost of A is blah. Let's say 10,000, B is 40,000, C is 700,000. You allocate it using that way. But that does not happen. It is either all relative fair values is given or one relative fair value is not given. Take note, only one relative fair value should be unknown. Okay? So dito, pag ito ang gagamitin mo, kailangan only one relative fair value is unknown. Pagka unknown lahat, hindi na pwede yun. Hindi na pwede yun. Okay? So that's it for our initial measurement. We proceed now to our subsequent measurement. So how do we subsequently measure inventory? So how do we subsequently measure inventory? It is lower of cost or net realizable value. Lower of cost or net realizable value. Take note, this LCNRV, is known as the impairment test of inventory. It is known as the impairment test of inventory. So if ever you are asked, what is the impairment test of cash? No impairment test of cash. Why? Stability of peso. Next, what is the impairment of AR? It is impaired through the doubtful accounts. What is the impairment test of NR? It is impaired by removing the NR and transferring it to AR. What is the impairment test of loans receivable? That is under your PFRS 9, your ECL model, past 39 incurred loss model. What is the impairment test of inventory? LCNRV. LCNRV. Okay, so I hope we're clear here that the impairment test of inventory is known as your LCNRV. What do we mean by LCNRV? We measure each particular type of inventory at lower of cost or NRV. So you measure item by item basis at LCNRV. So for example, we have here A, B, C. We have here cost, we have here NRV. So let's say the cost of A is 100,000, B is 150, C is 75,000. The NRV of A is only 80,000, B is 165,000, and C is 40,000. So we get the lower between cost and net realizable value. So which is lower? A, 100 versus 80, lower is 80. B, 150 versus 165, lower is 150. C, 75 versus 40, lower is 40. So we have here 270,000 pesos. 270,000 pesos. Now you know how to apply your LC and RV. But what is really NRV? What do we mean by net realizable value? What do we mean by net realizable value? Take note, guys, you have three main inventory items. We have your raw materials inventory, we have your work in process, and we have your finished goods inventory. Finished goods inventory. So if ever that is RMI, the NRV is equal to your replacement cost. NRV is equal to replacement cost. But take note of this. RMI is rarely impaired because it can be transformed to a finished goods inventory which has a higher value. Okay? So, ayan ha. If ever we talk about NRV, what is really NRV? If that is RMI, the NRV is equal to your replacement cost. But take note, rarely we impair it because if ever it is already completed on the production process, the value is now greater. How about work in process? What is the NRV? The NRV is equal to your selling price. Okay? NRV of work in process. NRV is equal to your selling price less cost to sell less cost to complete. Sir, why do we need to deduct cost to complete? Cost to complete because it's still under process. It's still under process, therefore it needs completion. How about cost to sell? Because you need to incur cost just to sell the product. Okay, so NRV of work in process is equal to selling price less cost to sell less cost to complete. Sir, why do we need to know what is the NRV of each particular inventory type. Because guys, if ever the problem will provide you only of the items and it does not give you of the NRV, then you need to compute on your own. And you should know what items are to be deducted and what items are not to be deducted. Okay, so WIP, selling price less cost to sell less cost to complete. How about finished goods inventory? So for finished goods inventory, that is selling price less cost to sell. So why is there no cost to complete? Because FGI is already complete. So no cost to complete because FGI is complete. So you will only incur cost to sell. That is the cost of selling the product. Cost of selling the product. Okay, so I hope we're clear as to how we will determine the net realizable value of each type of inventory item. So RMI, work in process, and FGI. Okay, now how do we account for the impairment? Accounting for impairment of inventory. So how do we account for the impairment of inventory? We account it in using these two methods. We have your direct method and your allowance method. Direct method and your allowance method. Under direct method, the impairment is incorporated in cost of goods sold. While in your allowance method, recognize an allowance for inventory write-down. This allowance for inventory write-down is a contra inventory account. Contra inventory accounts. Okay, so it will decrease the inventory. It will decrease the inventory. So what are the difference between your direct and allowance? So we have your direct, we have your allowance. So first, as to your recognition, as to the recognition of your impairment or your write-down, recognition of impairment or write-down. So we said in your direct, the impairment is incorporated to cost of goods sold. So you directly deduct inventory. So we just debit cost of goods sold, we credit inventory for the amount of our impairment or the write-down. For your allowance, we use your loss on inventory write-down, and we credit allowance on inventory write-down. Okay. Some teaches the allowance method as a debit on loss on inventory write-down and a credit to inventory. But if we really want to show why it is an allowance method, we need to set up the allowance account, which is the contra asset. And I think it's better to set up a contra asset rather than directly removing it to your inventory. Because now, if ever we directly remove it to your inventory, it looks like more of a direct method rather than allowance method. That's why in our discussion now, we use the allowance as an account rather than a direct reduction on your inventory. But take note of the effect. In your direct, it is directly added now to the cost of goods sold, while your allowance, it is added to your loss on inventory write-down. Later, we will discuss what is the effect of a loss on inventory write-down. Now, what if there is a subsequent reversal of impairment? Reversal of impairment. So for your reversal of impairment, we just reverse the values for direct. So we debit inventory, we credit cost of goods sold. While for your allowance, we debit allowance for inventory write-down. Okay. And then we credit gain on reversal of inventory write-down. Okay. Now, guys, the problem here is how do we reverse? How do we reverse? No problem with your recognition. Diba kanina kasi you just compare the cost to the NRV. And then we measure it at LCNRV. So let's just copy our previous example. So this is our example a while back. Okay, I'll just copy it and place it here. Okay, so the total cost here is 100 plus 150 plus 75. So this will give us 325,000. 325,000. The difference between the cost and the LC and RV is known as the impairment. The difference between the cost and the LC and RV is the impairment. So we have here an impairment amounting to 55,000 pesos. So this is our impairment. So how do we record it? If that is direct, we debit COGS 55,000, credit inventory 55,000. If that is allowance, loss on inventory write down 55,000, allowance on inventory write down 55,000. Clear? Okay. How about a reversal? So for a reversal, you just compare the you get again for the difference as to your LC and RV and your cost. If there is an increase in your cost, okay, so, diba, you have learned already in your impairment of loans regarding reversal, this is an increase on the value of the asset. So here, there is an increase on value of inventory. Okay, but take note, if this one is our rule, again, if this is the carrying amount, this is the LC and RV, you can only reverse up to the extent of this one. This is your reversal. So you can only reverse up to the extent of previously recognized loss on inventory write down. Okay, so for example, we just continue year one. So our cost is how much again? 325,000. And after our cost, we also have our LC and RV. So our LC and RV is 270,000. So this is, okay, 55,000. So this is our impairment loss, year one. So let's say on year two, we have the cost of 200,000 and our LC and RV is 240,000. So we have 40,000 increase. So this is an increase in value. This is known as your reversal. This is known as your reversal. So you can only reverse up to the extent of the previously recognized loss on inventory write down. But since our inventory write down initially is 55,000 and we reverse 40,000, this is enough. This is enough. Therefore, only 40,000 will be reversed. And how will we reverse it? Under direct method, we reverse it by debiting inventory and we credit cost of goods sold 40,000. How about under allowance method? Under allowance method, we debit allowance on inventory write down and then we have your gain on reversal of inventory write down 40,000 pesos. 40,000 pesos. Clear? Okay. So this example is if ever enough lang siya. What if hindi siya enough? So for example, year one, have your cost. You have here your LC and RV. So 325, 270,000. And then on year two, we have a cost of 200,000 and our NRV is 280,000. Okay, so here, as you can see, we have here initially a 55,000 impairment loss, 55,000 impairment loss. And there is now a subsequent increase of 80,000, And we said only up to the extent of previously recognized impairment loss, and that is 55,000. So we only can recognize a reversal of 55,000. So how do we record it? So you just debit inventory, you credit COGS 55,000 for direct. For your allowance, you debit allowance on inventory write down 55,000, you credit gain on reversal of inventory write down 55,000. Okay, so I hope we're clear with this one. Again, we have your costs, you compare it to your LC and RV, and then subsequently you reverse it, reversal, but only up to the extent of the previously recognized impairment loss. Okay, so I hope we're clear with this as to our LC and RV. So compare cost, compare NRV, whichever is lower, LC and RV. Now, if the cost is greater than LC and RV, then it is impaired. And how do we record the impairment? We record the impairment either through direct or through allowance method. Further, we can also reverse, but we can only reverse, guys, up to the extent of the previous impairment loss. Up to the extent of the previous impairment loss. Okay, so after knowing those, we also need to learn what is the proper presentation of the allowance. So we have here allowance on inventory write-down. We said this is a contra inventory account. Next, you have your gain on reversal of inventory write-down. This is a deduction to COGS. Next, we also have your loss on inventory write-down. This is an addition to COGS. So as you can see, pareho lang din naman yung effect niya. Kasi nga, di ba, sa direct, paano tayo mag-record ng impairment sa direct? We debit COGS, we credit inventory. Under allowance, we debit loss on inventory write-down, we credit allowance. Okay. So, sabi natin, loss on inventory write-down is addition to COGS. Addition to COGS. Eh, di ba, addition din to sa COGS? So, pareho lang talaga sila. Next, a credit to inventory. This will decrease the inventory. Allowance on inventory write-down is a contra inventory. Therefore, this will also decrease. So, the same lang talaga sila ng effect. Nasa method mo lang kung paano siya i-record. Nasa method mo lang kung paano siya i-record. So, I hope you learn about the effects of these entries and how to properly present it, and of course, to properly compute for the initial measurement and the subsequent measurement, especially the NRV, LCNRV of the inventory. Okay. So we're done discussing your initial measurement and your subsequent measurement, especially your LCNRV. So one item is still on your LCNRV is the purchase commitment. Purchase commitment. So what is this purchase commitment? So this is an agreement to purchase an inventory at specified units, specified price, and specified time. Okay, so purchase commitment, it is an agreement to purchase an inventory at specified units, at specified purchase price, and specified time. So, for example, on January 1, year 1, entered into a purchase commitment to purchase each year 50,000 sacks of rice for 1,000 per sack. Okay, purchase each year 50,000 sacks of rice for 1,000 per sack for 3 years. Okay, for 3 years. Now, what is our problem in your purchase commitment? You already set the price. You already set the price because the price is specified. So our problem is, what if the price drops? The price drops. What is the effect? The price drop here is treated as an impairment of the inventory. Impairment of the inventory. However, we don't call it as impairment per se by recognizing COGS and crediting your, what do you call this one? Inventory. But here in your purchase commitment, whenever there is an impairment of the inventory due to the price drop of the purchase commitment, then we record it as loss on purchase commitment and credit on estimated liability on purchase commitment. Okay, so ganun yung gagawin natin. So we just need to recognize the loss on purchase commitment and the estimated liability on purchase commitment. Okay, we go back first on purchase commitment. A purchase commitment is an agreement to purchase an inventory at specified units, specified price, and specified time. So for example, on January 1, year 1, we entered into a purchase commitment to purchase each year 50,000 sacks of rice for 1,000 per sack for 3 years. So what is the specified units? The specified units is 50,000 sacks. What is the specified price? That is 1,000 per sack. And what is the specific period of time? So 3 years. And then now, what is our problem and what is the connection of purchase commitment for LC and RV? Because during this particular period of time, the price may drop. The price may drop. Therefore, there will be a loss on purchase commitment. That is considered as impairment of the inventory. However, it is not impairment of inventory per se. I told you a while back, but we need to recognize a loss on the purchase commitment and estimated liability on purchase commitment, okay? So we need to recognize a loss on purchase commitment and estimated liability on purchase commitment. So how do we compute for your loss on purchase commitment? This is equal to your units multiplied by the change in price, multiplied by the period of time. Okay, so for example, on January year 1, it is 1,000 per sack, 1,000 per sack. Assuming on June 30 year 1, wala ka pang binili. Pero yung price per sack na lang, price per sack is only 500. So this is the NRV. This is the NRV. Therefore, there is a price drop. And because of this price drop, you cannot measure your inventory at 1,000 because the NRV is 500. So how much is the loss on purchase commitment? How many units? We are to purchase 50,000 sacks multiplied by the change in price. So from 1,000 less 500 multiplied by the period. So how many years left? Is still 3 years. Okay. So, sir, why is it important for us to know the period? So what if you already purchased on year 1 and then on year 2, but only the price drop happened on year 2. So you need to look at to the period. So kung ang nangyari ang price drop ng year 1, dyan mo i-recognize. Eh di 3 years yan. Pero kung year 2, eh di 2 years na lang yan. Ganon. Year 3, eh di 1 year na lang yan. At the end of year 3, eh di wala na. Ganon lang siya. So you need to know yung period kung kailan pa natin isa-satisfy yung purchase commitment. So dito, in-assume natin na wala pang na-satisfy. So 3 years pa natin yan kailangan nating isettle or obligated as to that particular purchase commitment. So how do we compute? Units times change in price times period. Sir, how do we compute your change in price again? That is the price per purchase commitment less the salvage value of the particular inventory. Or this salvage value is also known as your NRV. Okay, so how much is our loss on purchase commitment? Our loss on purchase commitment is 50,000 times 500 times 3 years. We have 75 million loss. We have 75 million loss on purchase commitment. Third question, what if there is a subsequent increase in the value? If there is a subsequent increase in the value, we just need to compare the amount of increase and the amount of your loss. Whichever is lower, you can only reverse up to that extent. Okay, sige, baka naguluhan kayo dito. So, naalala nyo yung kanina, so, andito yung ating cost, andito yung NRV natin, tapos nag-increase siya. You can only reverse up to the extent of the previous impairment. Okay? So, paano natin uli i-compute yan? So, again, based on the units and the change in price, of course, if ever there is an increase, times the period. But always compare to the actual loss on purchase commitment. Whichever is lower, yun yung kukunin ninyo. Okay? So, tandaan ninyo yan, ha? Pero, yun, kung hindi nyo nag-guess yung whichever is lower, balikan ninyo yung rule natin dito. Pag hindi na-guess yung whichever is lower, balikan yung rule dun sa cost and RV and subsequent increase. So, eto. Ayan. Okay? So, that's it for our purchase commitment. So, balikan lang natin, guys. Our initial measurement is equal to your purchase price plus conversion cost plus other costs. Subsequent measurement is LC and RV. If cost is greater than NRV, it is impaired. And how do we account for your impairment? We have your direct and we have your allowance. We have your direct and we have your allowance. And how do we compute for your NRV? It depends on the type of the inventory. We have your raw materials inventory, we have your work in process inventory, and we have your finished goods inventory. Raw materials inventory, this is known as your replacement cost. Work in process, that is selling price, less cost to sell, less cost to complete. Finished goods inventory, selling price, less cost to sell. How about reversal? If there is a reversal, take note, you can only reverse up to the extent of the previous impairment loss. Or we call this one your inventory write-down, okay? How about a purchase commitment? A purchase commitment, we can also recognize LC and RV here, and we can recognize impairment, but the impairment is not known as impairment or inventory write-down, but we know it as loss on purchase commitment, and we recognize an estimated liability on purchase commitment. Sir, why do we need to recognize an estimated liability? Because guys, you can purchase it outside at a lesser price, but because of the drop in price and because of the agreement, what will happen is you still need to pay it at the actual price. So you are liable more than the actual or the market value. So we need to recognize an estimated liability. Sir, question. Is your purchase commitment, can your purchase commitment be reversed? Yes, the same rule with your LC and RV, but take note of the periods again. Take note of the periods on how many periods is left. On how many periods is left. It can be the whole period of the term of the purchase commitment or certain periods only. So please take note on the problem regarding the purchase commitment as to the period of the purchase commitment. Okay? So we're done with our initial and subsequent measurement. So another topic for this particular video is, of course, our segregation of the cost of inventory, whether it will be part of your cost of goods sold or it is part of your ending inventory. Okay, so our main problem really is the cost of goods sold because ending inventory is based on the actual count, So our cost of goods sold is the problem. If that is a merchandise inventory, remember you have your periodic and your perpetual. Under periodic, you need to compute for the cost of goods sold. In your perpetual, cost of goods sold is computed based on the entries. Okay. So how do we compute for your cost of goods sold under your periodic again? So that is equal to your beginning inventory plus net purchases. How do you compute for net purchases? That is purchases less returns, allowances, and discount. You have your total goods available for sale less ending inventory. We have your cost of goods sold. Okay, that's for merchandise inventory. How about the computation of your cost of goods sold under your manufacturing concern? If that is a manufacturing concern, we still need to know for the cost flow. Okay, so just a review. We have your RMI, we have your work in process, and we have your FGI. Okay, so your RMI, we have your beginning, we have your purchase, we have your use, and we have your ending. So the use is placed here in your work in process. This is your RMI use. Okay, so beginning work in process, you add direct labor, you add overhead, less ending work in process, we have your cost of goods manufactured. So this cost of goods manufactured will enter your FGI together with your beginning, less ending, we have your cost of goods sold. Okay, so please do not forget this particular cost flow in case we are to compute for your cost of goods sold. So what is the ending inventory for merchandising? That is your ending merchandise inventory. For manufacturing, what is the ending inventory? That is equal to your RMI and work in process end and FGI end. Okay, so please do not forget these items. So again, last topic for this particular video, we need to separate the cost of inventory. We need to present it as to your cost of goods sold and as to your ending inventory. For your cost of goods sold, how do we compute it for your merchandising concern? It can either be periodic or perpetual. For your periodic, no problem because we need to compute for your cost of goods sold based on a formula. In your perpetual, it's more harder because you need to total the cost of goods sold that is entered in the books. Okay, so how do you compute for cost of goods sold under your merchandising concern? Beginning inventory, just net purchases, total goods available for sale less ending inventory. Please take note that if there is a freight in, add the freight in. If there is a freight in, add the freight in. Next, how about cost of goods sold in your manufacturing concern? We follow the cost flow from RMI to work in process until FGI to compute for your cost of goods sold. But what is the amount of your ending inventory for manufacturing? It is composed of raw materials end, work in process end, and finished goods inventory end. Okay, so that's it. That will wrap up our discussion for the measurement of inventories. Thank you.